Good evening, everyone. I am C. Gyati Gupta, the practicing chartered accountant from Meerut, the moderator of this webinar. We're delighted to welcome you all in this webinar being organized by PCLEA and NTU Committee of ICAI. It is my pleasure to be the moderator in this webinar on PMLA, which is based on basics and applicability to CAs on this day, 24th day of October from 5 p.m. to 7 p.m., being organized by Committee on Commercial Laws, Economic Advisory and NPO Cooperative of ICAI. In a short while, we'll start this webinar. I would like to apprise you about CCLEA and NPO committee. This committee is focused to encourage chartered accountants to shape strategy and policy that unlocks economic, financial, and social value while combining analytical foresight with commercial acumen. One of the key areas of this committee is to serve the multifunctional task of analysis, knowledge dissemination, inputs to regulators on policy formulation, to develop and publish technical guidance, background materials, etc. Not only this committee also helps in creating awareness for professional opportunities for chartered accountants in commercial laws, economic advisory, and NPO cooperatives. Our eminent speaker, P. Kinjal Shah ji, is amongst us, and he will deliberate on PMLA basics and applicability to CA in this webinar, and we hope that the same will be useful to members. Now, let me introduce our speaker to you. Mr. Kinjal Shah ji, he is a seasoned chartered accountant with over 22 years of experience in financial and capital markets, specializing in securities law, information systems audit, and forensic investigations. He's a fellow member of the ICAI. He has been in practice since 2001, holding additional credentials such as Diploma in Information Systems Audit, known as DISA, and certifications as an anti-money laundering specialist. Mr. Shah's illustrious academic journey includes securing the 8th rank at Mumbai University and earning a Government of India scholarship for post-graduation. Mr. Shah has played a pivotal role in investigating financial frauds for regulatory bodies like SEBI, FMC, CBI, and ED, and he has trained corporate intermediaries, including the board of directors of MCX, on regulatory risk management and PMLA compliance. His contributions to literature include co-authoring vital publications such as ICAI's Technical Guide on the Internal Audit of Stockbrokers and Handbook on PMLA. Beyond his professional achievements, Mr. Shah is actively involved in various prestigious organizations, serving as the Treasurer of Bombay Chartered Accountant Society, BCAS, and a member of several key committees at ICAI and BCAS. He is also a frequent speaker at seminars on diverse topics such as information systems audit, financial planning, and regulatory compliance. A visionary leader and a well-respected figure in his field, Mr. Kinjal Shah's dedication to both his profession and the financial community is truly commendable. I shall now hand over the meeting to Mr. Kinjal Shah ji to share his invaluable insights and expertise. Over to you, sir.
Thank you, Gyati. Let me share that this is a wonderful experience to be here at ICAI platform, sharing my knowledge with the fellow chartered accountants, and especially when there is a lot of concern as regards the PMLA, especially the notification which is now making chartered accountants accountable under the law, even as a reporting entities. So thanks to ICAI for providing me this platform to share my knowledge. Let me start the presentation. Is the presentation visible?
Yes, sir.
Audio is clear?
Yes, sir.
Okay, thank you. Thank you, Gabby. So friends, today we are going to deal with this session on PMLA, and especially, it's a matter of concern for chartered accountants to understand their responsibilities and obligations when they have been made reporting entities. So the agenda for today's session would be a broad introduction to what is money laundering, some important aspects of the PMLA Act, the FATF guidelines, the framework, then why there was a need for having professionals as a part of the reporting entities under the PMLA. We will also understand the third way notification, which is now made applicable to chartered accountants. And once that is applicable, we need to understand what are our obligations as reporting entities, which includes registrations, policies and procedures, client onboarding, transaction monitoring, reporting, and other obligations. And we will also touch upon another important notification, which is the 9th May notification, and we will deal with it as we arrive at there. So friends, introduction to money laundering. We will first understand what is money laundering. So United States Treasury Department says that money laundering is the process of making illegally gained proceeds, which is dirty money, appear legal or clean. As chartered accountants, being expert in the financial sector, uh, we have come across a lot of instances where this modus operandi is used not only for tax evasion but even to get rid of the tainted money which has been raised from the crime and to make it appear clean or legal. And as gatekeepers of the financial sector, it is our utmost responsibility to understand this concept and understand what would be our contribution or what is expected by the stakeholders from us. So where would money laundering happen? I would say money laundering is would happen anywhere. I mean, it is almost all profit generating crime where money laundering would happen because the person who has committed the crime would like to hide the source of that money. And because the objective is to get the illegal funds back to the individual who generated them, the launderers would prefer to move this money through stable financial systems. And again, chartered accountants play a pivotal role in regulating or assisting the stableness and cleanness of the financial systems. Money laundering, how does it happen? Uh, to put it, there are three stages which have been described by FATF or they are globally accepted, which is the placement, layering, and integration. So placement is putting dirty money into the financial system. Layering is where you move or separate the origin of those proceeds, which is the criminal background from those money through series of financial transactions, and then you integrate them where you create a legitimate explanation for their source of funds, allowing them to be retained, invested, used, or acquire other goods and assets. So while this process may not be in the same order, but these are the three broad stages. So to understand it, let me give you an illustration. Say for example, there's an entity which is into arms smuggling. They they buy illegal arms from say South America and provide it to countries in say Africa. Now they have received the money somewhere in a country in Africa where they have provided these arms. Now, how do they take this money back to their country or to the person who was supposed to be the kingpin of this entire transaction? So let's say what they will do is they will buy a cafe in that country. And as we all know, the business of cafe is such where most of the revenue or proceeds, sales proceeds, are generated in cash. So once he has bought this cafe and say the cafe's daily revenue is say $3,000, but what this guy will start doing is putting $10,000 every day in the bank, saying that these are my sales proceeds from business of running cafe. Once this money goes into the bank, we see that the banks would generally presume that since they have a business of running a cafe, the source would appear to be clean. The entity would legitimately pay tax, and once this money has been tax paid, they are free to take this forward through banking systems or financial systems anywhere globally, because they would say like we are acquiring a company somewhere in South America in a particular country, and that is where we want to move this money from a country in Africa to a country in South America. So this is what happens when a transaction which is placed into the system, then layered and integrated, and ultimately it loses that origin of crime and it start appearing to be legitimate. Again, I mean, this is the same typical example which I explained just now. So before we proceed, let us understand the historical background of how this evolved as a concept. So somewhere in 1990s, this concept started gaining acquaintances in the United Nations General Assembly. And there was a discussion on how do the member state adopt a framework whereby they are able to control or monitor money laundering. While there were a lot of resistance from the member countries on sharing of data, considering that they would not like to share the data of their citizens or the financial transactions of their citizens or the entities incorporated in those countries. And while the negotiations and discussions took a substantially longer time, but an event which occurred somewhere in 2011, 2001, what we call it as 9/11, was an eye opener for every country, including the most advanced country, where America was attacked by a group of terrorists who destroyed the World Trade Center on 11th of September. While US and other Western countries started investigating this, they realized that no terrorist activity would have been successful had they not received financial support. And this financial support moved through their banking systems and financial systems seamlessly without anybody realizing that this money could be used for a terrorist activity and could become a national security threat. Having realized this, the Western countries adopted the PMLA resolution, the AML resolution in the General Assembly, and all the member states were also asked to adopt this. The Indian Parliament enacted the Prevention of Money Laundering Act in 2002. While this was enacted in 2002, it took almost 2.5 to 3 years for the government to come out with the rules. It took a little longer. The reason was that this is not an act which is only to apply to India, but there were international ramifications. So this act was supposed to be in tandem or in synchronization with the United Nations Assembly resolution that was adopted by the member state. And therefore, there were a lot of nitty-gritties which need to be worked out. And ultimately, the act became effective from 1st of July 2005 in India. While we look at the historical background, we realize that the act has undergone numerous amendments over a period of time. Initially, the act was enacted in 2005. So if we look at the period which is 2005 to 2014, which is almost 10 years, the act was amended twice, once in 2009 and 13. But if we look at a historical event which happened in 2014 was the change of government at the center, and the Modi government, when it took over the reins of the country, being proactively aware that if we want to control the terrorist activities and to control be in grip of the national security, what is required is we need to monitor these financial systems which are misused for terrorist activities. The act has undergone multiple changes thereafter: 2015, 17, 18, 19, 22, and 23. So if we look at it, in 10 years, it has almost undergone more than 5 changes, which is, I would say, every alternate year there has been changes. The act has been modified to make it more effective. One of the exception to this law was that this was also, this law was applicable to the whole of India, including the erstwhile state of Jammu and Kashmir. And while we are all aware that Jammu and Kashmir had a separate constitution, and most of the laws of the federal government, which is the central government, did not apply to that state of Jammu and Kashmir, including the taxation laws, the indirect tax laws, the stamp duty laws. This law was also applicable to state of Jammu and Kashmir because the constitution of Jammu and Kashmir used to state that anything which pertains to national security, including the state security, would be managed by central government. And since this act was to have sufficient security about national security, the act of PMLA was also applicable to the erstwhile state of Jammu and Kashmir. This is just to give you an importance or an understanding of the law. So if we read this preamble to this act, which is the PMLA Act 2002, it states that it is an act to prevent money laundering and to provide for confiscation of property derived from or involved in money laundering and for matters connected therewith or incidental thereto. While there are a lot of people who get confused between PML and AML, let me state that both the acronyms are used interchangeably in regular parlance, and both means the same. While PMLA is the name of the act, which is Prevention of Money Laundering Act, the AML would stand for Anti-Money Laundering. So let us understand the important aspect of this PMLA Act 2002. So it is an offense of money laundering, which is defined under Section 3, and it says that whosoever directly or indirectly attempts to indulge or knowingly assists or knowingly is a party or is actually involved in any process or activity connected with the proceeds of crime, including its concealment, possession, acquisition, or use, and projecting or claiming it as untainted property, shall be guilty of the offense of money laundering. So, if we look at this particular section, it not only covers a person who has perpetrated the crime of money laundering or who has committed an offense of money laundering, but it encompasses all those people who have assisted him or they are actually party to that crime, also as if they have been the accused who have committed a crime. This is where a lot of times we see that this particular section gives enormous power to the prosecuting agency, which is the Enforcement Directorate, where we have seen a lot of professionals who have been interrogated, who have been charged with the offense of money laundering, or they have been put behind bars, the arrest has happened, is because the prosecutor would always say that a professional, especially like chartered accountants or company secretaries, because of their professional understanding of how financial systems work, they would or they may have assisted the accused, and therefore the professional is also charged with the same offense of money laundering. We have seen in a lot of cases where the parties who are called for investigation, they would simply state that I am not aware of this fact, what has happened, I don't understand financial activity. You may ask my tax return preparer or my tax consultant or my chartered accountant, and he would be able to answer you. So in turn, what happens is he's shifting the onus from himself. While he has committed a crime, he shifts the onus to his chartered accountant or tax professionals. So every professional needs to exercise caution to what extent he is assisting the client and what are his boundaries as a professional. So further clarification which was made in the act, it says that a person shall be guilty of offense of money laundering if such person is found to have directly or indirectly attempted to indulge or knowingly assisted or knowingly is a party or is actually involved in one or more of the following processes or activities well connected with proceeds of crime. So he may not be initially involved in the crime itself, but he has subsequently dealt with the proceeds of crime, and it includes concealment, possession, acquisition, use, or projecting as untainted property or claiming as untainted property in any manner whatsoever. So this is something where projecting or, as untainted property, where a lot of professionals face hurdle because while a part of their tax liability, professionalism as tax consultant, they would have guided their clients for something which could be legitimate. But once you cross the boundary and if you are found indulging into certain activities to help the accused or an offense, a person who has committed an offense of money laundering as professional, the same person would also get liable to be prosecuted for the offense of money laundering. It further says that the process or activity connected with proceeds of crime is a continuing activity. It doesn't stop the moment a particular event occurs, but it continues till such time a person is directly or indirectly enjoying the proceeds of crime by its concealment, possession, acquisition, or use, or projecting as untainted property, or claiming it as untainted property in any manner. So, say for example, there was a crime, like say arms smuggling, narcotics. The accused has received the money. The money was put into some real estate, and over a period of time, he has been getting rent from that real estate. So, according to this definition, what would happen is that the money that he had received no longer exists because that has been converted to some other form of asset. But by converting that money into some other form of asset, he still continues to enjoy the outcome of that asset. And whatever outcome he enjoys, they are proceeds of crime. And therefore, the prosecuting agencies or the enforcement directorate would have the power not only to attach that property, maybe residential, commercial, whatever, but also have control and attachment on the rental income that is being generated by that property. So while we were assisting the law enforcement agency in one such case, the officer shared one interesting case, which the judgment which was passed at that point of time by the court. In that case, a person was charged with the proceeds of crime, I mean, offense of money laundering, and the prosecuting agency could prove that those proceeds of crime were to some extent invested into the property which he is in possession of. So the accused argued that he has only one property where he is residing, and the court should not pass an order for attachment of that property because that would be against a humanitarian stand of evicting a person from his residential house. While court agreed to his request of not evicting him, it said that since the property would be under symbolic attachment of the enforcement directorate or the law, you may continue to reside within that property, but the enforcement directorate would be authorized to calculate the fair rent of that property, and you would be under obligation to deposit that rental, equivalent rental value every month to the deposit of the courts. So these are the kind of stand that court are willing to go and take, even in case where an accused had only one residential property. So while it allowed them to stay, it asked for them, I mean, it asked the accused to deposit the rent as if he had been staying in a rental property. So what is proceeds of crime? Now, why is it important? If we go back to this definition, the third bullet says the offense of money laundering is about proceeds of crime. So if there are no proceeds of crime, there is no offense of money laundering. So what is proceeds of crime? Let us understand what is proceeds of crime. Section 2, subsection 1, clause U states that any property derived or obtained directly or indirectly by any person as a result of criminal activity relating to a scheduled offense, so that are proceeds of crime, or the value of any such property. So if you have converted it into some other form or you have used it, then the value of such property would also be treated as proceeds of crime. And where such property is taken or held outside the country, then the property equivalent in value held within the country. So what does this mean? The government made this modification based on its realization on how it dealt with the offenders of money laundering. What happens is there is an offense of money laundering. The person received the money, but he has spent it on his luxuries, and the money no longer exists. So what is there that is liable to be attached? That was the subject matter. So the government amended this and said that the value of any such property would also be liable to be attached, and that would become proceeds of crime. In another case, what happened was the accused took the entire money outside the country along with him. He transferred the money, and there was nothing held within the country. So the amendment said that if somebody has taken the entire proceeds of crime outside the country, then the property equivalent in value held within the country would also be considered to be proceeds of crime. So let us understand there was Mr. X who got 100 crores out of, say, a case involved in where he was involved in corruption. He has transferred this entire money and he has also been absconding out of the country. So there is nothing, neither the offender nor the money that he received is within the jurisdiction of India. But let's say he had acquired previously some property, maybe gold, jewelry, real estate, out of the money which were from legitimate source. So now this clause says that even if nothing has been left which was acquired out of the proceeds of crime, then his other assets which are equivalent in value would also be treated as if they were acquired from the proceeds of crime, and therefore they are liable to be attached and confiscated. So there was a further amendment in 2019. It says that proceeds of crime include property not only derived or obtained from scheduled offense, but also any property which may directly or indirectly be derived or obtained as a result of any criminal activity relatable to the scheduled offense. So what are the scheduled offenses? What is important is now we understand what are scheduled offenses. The scheduled offenses have been divided into three categories, which is Part A, Part B, and Part C. There are 29 acts which have been listed in Part A, and the scheduled offenses as defined in particular sections or subsections of that act have been defined in Part A, and it does not state that there are any monetary limits. So even if you have committed a crime for which you have received no consideration or you have received a nominal consideration, that's okay. As far as it is an offense of that particular law, it would also be classified as an offense under the PMLA Act. In Part B, there is only one offense, but there is a threshold limit that if that offense is exceeding 100 lakhs, which is 1 crore rupees, then only it would be treated as offense of money laundering. In the Part C, it deals with trans-border crimes, where the offender is in some other jurisdiction, the crime has been committed in some other jurisdiction, the properties may have been acquired in third jurisdiction. So these are the kind of trans-border crimes. So it consists of 2 offenses in addition to all the offenses that have been listed in Part A. And all these put together are offenses of money laundering. And the money that is received out of this, they are called proceeds of crime. And those proceeds of crime, when it is received from scheduled offenses, they are treated as offense of money laundering. So I have given an illustrative list of some of the law which are treated as scheduled offense in Part A, which is like Indian Penal Code, now it is called BNS, the Copyright Act, UAPA Act, Prevention of Corruption Act. Something on the right side is more surprising for a layman, like Copyright Act, Trademark Act, Information Technology Act, Offense of Child Labor Act, or a SEBI Act 1992. So these are as such all civil laws. They are not criminal in nature, but here it has been stated that if particular provisions of this law have been violated, they would still be treated as offense of money laundering. The Environment Protection Act or the Water Prevention and Control of Pollution Act, Child Labor, Air Prevention and Control of Pollution, and Immigration. Recently, they have also added Section 447 of the Companies Act that deals with punishment for fraud and now it shall be treated as scheduled offense under the PMLA. Now, why this was added? While fraud is adequately governed under the Section 420 of the Indian Penal Code, so somebody who commits a fraud can easily be prosecuted under Section 420 of the IPC. But government realized that over a period of time, there were a lot of hindrances in proving that crime under Section 420 of the IPC because of its definition, and there were a lot of limitations. The onus was more on the prosecuting agencies to prove that fraud. While Section 447 of the Companies Act is very, very wide, it deals with sophisticated frauds which are more relating to financial crimes rather than other nature of crimes. And therefore, it's more easier for the prosecuting agency to prove that a fraud has been committed. Now, what is the implication of this? The implication is the cases like Ireland FS or similar other cases where a lot of money of the investors were siphoned off. This would get classified under Section 447 of the Companies Act as fraud. And the moment it has been established that this is a fraud under Section 447 of the Companies Act, it would become an offense because it's a scheduled offense. Whatever money has been raised out of that or acquired out of that or any other property that has been acquired using this modus operandi of crime would become proceeds of crime, and therefore it would tantamount to an offense under the Money Laundering Act. So the government has been very, very proactive. I have seen cases where even the attachment orders have been passed by the court because there was a factory which discharged its untreated effluents and chemicals into a nearby river, and therefore they were charged with Water Prevention and Control of Pollution Act. And the moment that provisions were invoked and proved that yes, they have violated that, it became an offense of money laundering. The moment it became an offense of money laundering and the cases were filed against those entities in the court was convinced that yes, it's an offense of money laundering. And based on the request of the prosecuting agencies, it passed an order saying that whatever sales has occurred from this particular factory, which discharged its untreated effluents into the river, nearby river, should be confiscated or attached and deposited under the control of the prosecuting agencies till the case is disposed of. So these are the extreme situation where somebody may commit a mistake or a crime under one of the law, which ideally doesn't appear to be very criminal in nature, but still you may become an offender under the Money Laundering Act. Again, I would state that the entire law will not be stated as an offense of money laundering. Like say, for example, if I refer to the Indian Penal Code, it doesn't mean that any and all provisions of the Indian Penal Code, when violated, would become an offense of money laundering. The PMLA Act has specified the sections, and if those particular sections are violated, then only it will become an offense of money laundering and not the, it doesn't contemplate or encompasses all the provisions. They are selected provisions based on which it will be treated as offense of money laundering. Part C, we will not deal with it, but it also includes Black Money Act. So any violation of the Black Money Act, anybody who receives a notice, we have seen a lot of times when black money, notices relating to violation of the black money law is received, they also state that they have power to intimate this to Enforcement Directorate, and prosecution under PMLA Act would also run concurrently apart from the violation of the Black Money Act. So what is the punishment in case a person commits an offense of money laundering? So the penalty can be it should not be less than 3 years and may extend up to 7 years. However, if it is a crime which is relating to narcotics, then instead of 7 years, the upper cap will be raised to 10 years. Now, let us come to the regulatory agencies under the PMLA Act. Ideally, under any law, we have one law and one regulatory agency which administers this law. Like for direct tax, we have CBDT. So the CBDT or the income tax department would ensure compliance of the provisions of the income tax law. They would also have an intelligence unit. They would also have an adjudicating unit. So different units, but again encompassed or consisting under the same division. While if we look at PMLA, they have two wings. One is called the ED, which is the Enforcement Directorate. It comes under the Revenue Department of Revenue Ministry of Finance. And its job is to investigate cases of offense of money laundering and would be responsible for ensuring proper prosecution of the offenders. On the other hand, there is another wing, which is the Financial Intelligence Unit of India, which is FIU. It's the central national agency to facilitate information sharing among various law enforcement agencies and international FIUs. And it reports to the Economic Intelligence Council under the Ministry of Finance. Now, why do we need a separate wing for intelligence collection? Most of the law where we see the intelligence collection is included within the same team of people who administer this law. Considering that this law is something which is unique in the sense that to manage national security and to avoid terrorist activities, there has to be a lot of intelligence gathering and intelligence sharing. And not only between the departments of the agency which monitors or executes or prosecutes PMLA, but between various law enforcement agencies. And not only nationally or domestically, but it might also need to share those information with various other FIUs, including FIUs located in foreign jurisdiction or international FIUs. So this is a separate intelligence wing which only does the task of gathering or collating information, compiling it, review it, and sharing it back with various other law enforcement agencies. So what are the functions of FIU India? Now we will be dealing primarily with FIU India because as chartered accountant, what the notification state is, we are reporting entity. The moment we are reporting entity, we are required to correspond with, do our correspondence with FIU India, which is the intelligence unit. More or less as chartered accountants or as reporting entities, we have not much to do with the role and responsibility of enforcement directorate. So today as our role as a reporting entity, we will be focusing on our role and interaction with FIU. So it includes collection of information, analysis of information, sharing of information with various law enforcement agencies and regulators, act as central repository, and do research and analysis on various aspects relating to intelligence gathering. So let us come to what is a reporting entity. So reporting entity has been defined in section 2, subsection 1, clause WA, and it includes various kind of entities, which includes banking company, financial institutions, intermediaries, and then there is a residuary clause, which states that a person carrying on a designated business or profession. But the central government would have the power to notify these classes of people who would be designated as specified business or profession who would become reporting entities. So there are a lot of chartered accountants where their clients have approached them because recently the central government 2 years back had notified that all RERA registered estate agents, they would also be person carrying on designated business. And that is where around 15,000 plus notices have been issued to RERA estate agents, asking them that why have they not registered themselves as a reporting entity. So this is because of this provision, which is section 21WA, which empowers the central government to notify those businesses. Similarly, the profession of chartered accountants, company secretaries, cost accountant was also notified to be a reporting entity. Now, how does FATF come into play? FATF is a global agency. It's a global watchdog for dirty money and terror financing. It is a task force. It's a financial action task force and a global watchdog. And it sets standards for the countries to fight the financial crimes. So it helps them, gives them support that what kind of standards they should be setting across. They, on a periodic basis, evaluate countries and offers improvement for suggestions if their programs on anti-money laundering are found not to be satisfactory. And based on its assessment, it classifies those jurisdictions based on risk level. India is a signatory or a member of FATF since 2010. And we have seen that there are a lot of countries which have been put under higher risk level by FATF. Like some 2.5 years back, Pakistan was put under grey list. Similarly, UAE was also put under grey list because it was found wanting on its implementation on the anti-money laundering provisions. 6 months back, they were out of that grey list, the UAE. And we all know the kind of problem they faced when they were part of that grey list, because no foreign institutions would be interested in investing or transacting through a jurisdiction which is under grey list, because they themselves are also looked upon very suspiciously when they transact with such grey list countries, and their banking and other regulators would put them into higher risk categorization, and they face more of a problem when they transact with countries with grey list or blacklisted countries. India was last evaluated in December 23. Lot of efforts were put in by the government and the FIU, and India had successfully cleared 37 of the 40 stringent evaluation parameters. And by doing so, India is now in the exclusive club of top performers, joining UK, France, and Italy from G20. So there are only 3 countries who are in this elite club who have been able to implement the highest standards of anti-money laundering. And India has surpassed the US, China, Germany, Japan, and Canada for maintaining higher standards in curbing money laundering and terror financing. So this recognition gives a lot of comfort to foreign institutions who want to invest in a jurisdiction, stating that they have very powerful, very robust anti-money laundering provisions in place. And therefore, you will see a lot of money which flows will always, the institutions would prefer to go through those jurisdictions which are other than grey list or blacklisted countries. Now, a question may arise that all this is okay, but as chartered accountants, what was the need for the government to include professionals like chartered accountants, company secretaries, or cost accountants to make us reporting entities? So what is important is we understand what is the FATF roadmap, the framework. Its framework is to strengthen and enhance the reporting mechanism to identify potential offenders. And to effectively implement that, FATF came out with recommendations number 24 and 25. The recommendation number 24, it focuses on identifying and mitigating terrorist financing risk associated with designated non-financial business and professions. And recommendation 25 emphasizes customer due diligence measure for designated non-financial businesses and professions to prevent accounts being misused for money laundering. So this was the compelling reason that we were supposed to be evaluated in December 23, and there were this recommendation number 24 and 25 which were pending to be implemented. And that is where the government had to come out with those notifications to ensure that we comply with these recommendations number 24 and 25. And we all understand the recognition that India has got by implementing all these standards effectively, where it was able to clear 37 of the 40 stringent parameters of evaluation. While in India, a lot of chartered accountants may not be effectively doing what globally the law firms and accounting firms do. But if to give you an illustration, I mean, if you go to Mauritius, there would be a law firm or an accounting firm sitting in some 2,000, 3,000 square feet office, maybe a small piece of office, and almost having maybe 2,000, 3,000 registered entities operating from that same premises. So it allows them to be registered by providing their addresses and effectively managing those entities. While India, this is not on that scale, similar to what happens in those jurisdictions. But since this was a global recommendation, the same was also implemented by the Indian government. Again, the inclusion of accounting and legal professionals under AML law is a growing global trend, again because of the recommendation 24 and 25, and is driven by the recognition of their potential vulnerabilities to be misused by the criminals. And there are various countries like US, Canada, UK, and Australia who have already implemented and made their lawyers, chartered accountants, and company secretaries and cost accountants accountable and reporting entities to report any financial crimes or money laundering crimes. So, friends, let us now go to the applicability of PMLA to chartered accountants, which was notified by a notification dated 3rd May 2023 by the central government. So, the central government said that following financial transaction carried out by a chartered accountant, while it says chartered accountant, company secretaries, and cost accountant, but considering that today's target audience is chartered accountants, we will be restricting it to the word chartered accountant. In practice is very important. On behalf of his client, in the course of his or her profession, shall fall under the purview of PMLA for buying and selling of any immovable property, managing of clients' money, securities, or other assets, management of bank savings or securities account, organization of contribution for creation, operation, or management of companies, creation, operation, or management of companies, limited liabilities partnership firms, or trust, and buying and selling of business entities. So if any chartered accountant who is into practice, he carries out these activities on behalf of his client in the course of his profession, then he will be governed by this notification. So it is very important that we understand that who will be governed, whether it is not that all practicing chartered accountant by default become reporting entities. It is only if you fulfill this criteria, a chartered accountant will become a reporting entity. So the notification is applicable to chartered accountants who hold a certificate of practice, either individually or through a firm. They are carrying out certain financial transactions. Those financial transactions have been listed here as point number 1 to point number 5. The activity should be on behalf of his or her client, and it should be in relation to those specified activities. So the funds resulting from the specified activities related to financial transactions or required for execution of those transactions are routed through or managed by chartered accountant. And therefore, a practicing chartered accountant, out of any of these specified activities, if they are carrying out those activities, it shall be treated as reporting entity, and they will be required to comply with the guidelines which has been issued by FIU India and ICBI. So one question which people ask is, I do make tax payments on behalf of my clients. The money comes to my account and then I make the payment. Will I be liable as reporting entity under the PMLA Act? No, not all client related payments handled by chartered accountants fall under PMLA. So what would not be covered or what would be exempted? All payments on behalf of client pertaining to taxes, statutory fees and levy, registration charges and fee for other professionals, such as senior counsel. Like there are a lot of chartered accountants who are into tax practice. When there are litigation matters, they hire senior counsels who represent the client, while the client may be quoted a consolidated fee and the cost of the counsel is borne by the professional as a part of the assignment, a consolidated assignment. In such case, he might have received money on behalf of the client, including the fees for other professionals. So that is not covered if that is the activity which a chartered accountant does. Again, these are all Q&As which have been taken from the FAQ issued by ICAI for specifically for PMLA. Then the question would arise generally in the mind of chartered accountant is that I am providing the following services. Would I be covered under PMLA? Something like accounts and book writing services, auditing, attestation and certification services, special purpose audit reports, furnishing of returns or information related to direct tax and indirect taxes, tax audits and other review services, services under FEMA, MCA, RERA, etc. Paying taxes we have already discussed. The chartered accountant making an application for PAN, TAN, GST, PF, VSIC, trademarks, etc., including incorporation services, whether they would be covered. A chartered accountant or a firm of chartered accountant helps the client incorporation of companies or LLPs or trust. And helping client with project financing. So let us see the response that ICAI has given in its FAQ. As regards accounts and book writing services, this will not be covered under PMLA, but provided the chartered accountant is not managing any funds or bank accounts of the clients. Now the question would arise, how would an accountant manage client funds and bank account? Under what scenario will you do that? So to give you an example, there are a lot of chartered accountants nowadays who work as virtual CFOs. While they hold their COP, a client may not be able to or willing to afford a full-time CFO. They hire the services of such chartered accountants who provide people on part-time basis. They go to their office or they manage the affairs. They are even authorized to operate the bank accounts and run and operate the transactions, the financial transaction, as if he had been a full-time CFO of the company. So if this is the activity that a chartered accountant is doing, where he is allowed to operate the bank accounts of the client, then he would probably, he would become a reporting entity under PMLA. But somebody is purely into book writings, account writings, he need not worry, he is not under, covered as reporting entity under PMLA. Then there could be auditing, attestation, and certification services that is not covered. Special purpose audit, due diligence reports not covered. Furnishing of returns or information related to direct tax or indirect taxes, they are again not covered. Services under FEMA, MCA, RERA, etc. They are not covered provided the chartered accountant is not managing client funds. Paying taxes on behalf of the client, we have already discussed this. And making application for PAN, TAN, GST, again not covered. Incorporation of companies, LLPs, and trust not for buying and selling purpose. So if a chartered accountant is helping a client incorporate a company, that would not be covered provided the chartered accountant does not manage client funds and assets. Incorporation of companies, LLPs, and trust. There are a lot of chartered accountants. What they do is, or rather, they used to do previously. Now this has reduced substantially because the systems have been driven by technology, where incorporating a company does not take more than 15 days. But previously, when everything used to be manual, there were a lot of chartered accountants. What they used to do is they periodically incorporate some of the companies or trust or LLPs. As and when the client needs those entities to carry on its business, these entities would be sold off. Now, it says that if that is the objective of incorporating a company, which is for the purpose of buying and selling of such entities, then a chartered accountant will become a reporting entity. Project finance, surprisingly, the answer is yes. The institute states that since it involves organization of contribution or creation, operation, or management of companies, this particular activity would get covered as a reporting entity, would make the chartered accountant or firm liable to be a reporting entity. Whether CA acting in the following capacities are covered under the notification. So there are various activities where chartered accountant provide the service. Say, for example, official liquidator, insolvency professional, independent directors, nominee director, recovery consultant, executor of the will, insurance broker, trustee. So let us evaluate what are the implications. The ICI FAQ, which clarifies this, states that official liquidators, insolvency professionals, independent directors, nominee directors, they are not governed or they are not covered under this notification. The client, the CF or a CF firm is acting as a recovery consultant. The answer is yes. You are acting as a recovery consultant. You are liable to be registered as a research entity because you deal with clients' money or you deal on their behalf. Executor of the will. It says that yes, it is applicable only when a client relationship is established. Here, I will take a pause for a moment. There are a lot of chartered accountants from the fraternity of chartered accountants where they are trusted advisors of their client or their relatives. At times, client trust their chartered accountants even more than they would trust their legal heir like son, daughter, or somebody else. And they name the chartered accountant to be an executor of the will. The reason is even they understand that their family members would also respect it when this will is opened and executed after the person has deceased. Now, it says that if there is a client relationship which is established, the chartered accountant will become a reporting entity. But if there is no client relationship, then a chartered accountant, even though he is the executor of the will, he is not a reporting entity. Now, chartered accountants take up these assignments not only professionally in terms of money, but also to create a goodwill to help the society or to help their relatives, near and dear friends. At times, these near and dear friends are also have a client relationship. Like say, for example, I am filing a tax return for my uncle. He is very senior in age. He has now made a will and he has named me as the executor of the will. I agree to accept this assignment. Now, in the engagement letter, I should get it clarified whether I am accepting this in my professional capacity or in my personal capacity. Because if I do not adequately justify that in the engagement letter, it may turn out that since you had a relationship with your uncle, which was also in the nature of client relationship, because you are filing his tax returns, and if I accept that as it is, then I become a reporting entity. just to safeguard that you are not attracted by the particular notification. If you are going to do this activity pro bono out of your obligation towards the society or a relative or a friend, please ensure that you have a duly signed engagement letter which specifies that this is not in your, I mean, as your client professional relationship, but it is out of your personal relationship. Insurance brokers, yes, it says because it involves managing of clients' money. Insurance broker, I mean, a form of chartered accountant, who are also acting as insurance brokers, they would be classified as reporting entities. Public trust, if it is not out of your client relationship, then not governed. Private discretionary trust, yes, you become a reporting entity. Question 1. As a CA, if I handle financial transaction using power of attorney, does the PMLA apply to me? There are a lot of chartered accountants who are given the power of attorney to not only dispose of or acquire the assets, but even to manage the funds or bank accounts or other assets of the client. So the answer is yes. A chartered accountant in practice executing certain financial transaction under a power of attorney fall within the purview of PMLA 2002. It is crucial to remember that this applies only if the transactions are carried out in the course of your profession. Again, very important, if you are doing it pro bono out of your love and affection or relationship, a personal relationship, because somebody trusts you, please ensure you have a letter which specifies that these services are not being rendered in your professional capacity, but out of your personal capacity. So if it has been given by relative, yes, obviously not covered, but make it abundantly clear that it is not in your as a professional engagement. So what are the benefits of having a well-defined scope as a part of the PMLA compliance? So that would help me to have clarity on my professional versus personal transactions. It helps me distinguish those categories of transaction, and therefore I would be able to decide what are the transactions which are in my report capacity as a reporting entity, and what are the transactions which are outside the purview of it. It also helps you identify PMLA and relevant transactions. So you are able to identify the transactions which fall under PMLA, do proper customer diligence, and also report the transactions wherever required. And the biggest benefit out of this is protecting yourself. Documented scope serves as evidence that you have acted with within the professional boundaries defined potentially, and shielding you from liability concerned related to PMLA. Does this mean I can just ignore PMLA for all the personal transactions where I'm involved? The answer is yes, you may ignore as per third May notification. You are not covered if it is in your personal capacity. But remember that you can also be prosecuted under other provisions of PMLA or under the Code of Ethics of ICAI. What are the obligations of chartered accountants? Having realized that I have undertaken certain transactions in my professional capacities and they fall under that category of specified transactions, I am supposed to register. Having registered myself as a reporting entity, what are my obligations? So it says that to verify the identity of its clients along with the beneficial owner, maintain such records and for such period as may be prescribed, to report to the concerned authorities, which is the FIU, as per the prescribed procedure and manner. And the last is to carry out enhanced due diligence. So these are the broad obligations of reporting entity upon becoming a reporting entity. So let us understand that what is the workflow. Once a firm of chartered accountant is a reporting entity, how does it go ahead and implement the anti-money laundering provisions or the provisions of PMLA? So the first thing which a firm is supposed to do is register as the reporting entity with ICAI. Then it should establish policies and procedures and appoint a principal officer and a designated director. At the time of client onboarding, it should do KYC. CDD is customer due diligence. EDD is enhanced due diligence and sanction screening. Monitoring of transactions which are suspicious in nature, and would also have to do counterparty screening. We will discuss what is counterparty screening in some subsequent slides. Out of this reporting, monitoring of transactions, if they conclude that there were certain transactions which were suspicious in nature, the CA firm should report it to the Financial Intelligence Unit. The only exception in this case is this notification of 3rd May, where the professionals have not been asked to register directly on the FinNet gateway of FIU India, but they have been asked to register through their regulatory bodies like ICI for chartered accountants, ICSI for company secretary. Apart from this, they are supposed to maintain records of transactions, employee training, and periodic review. Registration of reporting entities. So, practicing chartered accountants engaging in the specified activities shall register with ICI by filling up the form which has been provided by ICI. I have given the link of that form in my presentation, which would be circulated by the organizers, and that would be for your ease to download the form. So, internal policies, procedures, and controls. What is that a reporting entity should have? So, first is appointment of designated director, principal officer, and branch level compliance officer. Again, an exception under the PMLA law. No other intermediaries or banks or financial institutions are required to have principal officer or a branch level compliance officer. Principal officer or what we call it as a branch level compliance officer. They are only supposed to have one director and one principal officer, but in case of professional firms, they want every entity to appoint a compliance officer for each and every branch from where they operate. Customer identification, risk profiling, and customer acceptance. Customer transaction monitoring is also one of the aspects which should be included in policies. The policy should also cover on how do one identify the red flag indicators, and having identified the red flag indicators, having concluded that this particular transaction is suspicious in nature, it should have a reporting mechanism for reporting those transactions to FIU India, not directly, but through ICI. And should also maintain policies on maintenance of records. Appointment of firm and proprietorship concern, if the reporting entity is to appoint designated director, who shall be the managing partner or the proprietor as the case may be, and appoint any officer as a principal officer. So what it says is that who can be the designated director? It is only the managing partner or the proprietor. There are a lot of professionals who do not have name of the firms. They practice in their individual capacity. If that is the case, it states that you should only have principal officer. There is no need to have designated directors. What is the role and responsibility? The designated directors to ensure overall compliance with the obligations under Chapter 4. And the principal officer is supposed to ensure reporting of transactions to ICI under Regulation 8. So overall, if we look at it, implementing internal mechanism, communicating firm-wide policies, and ensuring compliance with statutory requirement is what is the obligation of I. What are the steps involved? It says that at the time of onboarding of a customer, you will do customer identification, CDD, risk profiling, sanction screening, and risk assessment. Let us spend 2 minutes on this. These are very important aspects. Customer identification, they have given the list of documents that you are supposed to obtain from a customer when you want to do a verification, like what we face when we go to banks or stockbrokers or to open a demand account. They diligently ask for these documents. Unless they are submitted, we are not never onboarded as clients. So the same thing needs to be done by CFOs. Now, this identification also includes identification of ultimate beneficial owner. This is something a different concept. What happens is you may be onboarding a customer who is a corporate entity or an LLP, and you've taken their certificate of incorporation, their address proof, and all those things. But what the law says is that the person who has become your client, you should identify who are the people who are going to manage this entity. You need to do their credential checks. To do that, I need to identify who they are. And therefore, I'm also required to obtain all the legal documents pertaining to the shareholders and management. I mean, about the specified limit, not every shareholder. I should be obtaining the relevant KYC documents of not only my client, which is a company, but also the management, which consists of directors and I mean public interest directors and all those things, or in case of LLP, managing partners. And that entity as a shareholder, which is a non-living person, like say for example, X Limited as investors or shareholders, out of which Y Limited holds 25%. In that case, I should also do the due diligence of Y Limited. I should be asking the documents and ownership details of not only X Limited, but also of the Y Limited. Based on this, the profiling and everything, you would do a customer due diligence. You will do a customer due diligence to form an opinion on the risk profiling of the customer. Like say, for example, somebody getting onboarded as a customer with a CA firm. The CA firm identifies that there are 4 shareholders and they have obtained the documents. Out of those 4 shareholders whose documents have been obtained, the CA firm, upon further investigation, finds out that there was Mr. P, who is also among one of the shareholders, and he is primarily from North Korea. Now, this is a country which is under the sanction list, which is under a relatively higher risk. And therefore, when I do this customer due diligence, based on that, I should do a risk profiling of my investor, my customer, and I may not be able to put its ranking as low risk. I may have to put a little bit of higher risk considering the nature of its association. Similarly, there are sanction screening. So if there are A, B, C, D who are the partners of an LLP, we realize that one of the partners, let's say D, is part of the sanction list of the United Nations. That could be for multiple reasons as well. But if that is so, we need to put this client, who is our client who is engaging with us, into maybe probably a high risk category. So that is about risk assessment. On an ongoing basis, what are you supposed to do? On an ongoing basis, you are supposed to do enhanced due diligence for your clients, transaction monitoring, and counterparty screening. Now, what does counterparty screening mean? Counterparty screening means that I have been appointed as a virtual CFO of a company which is located in, say, Hyderabad. I go there once a month. I sign all the checks because I manage it. Uh, Hello. So I have identified a client who is on the sanction list, or he has some connection to an entity which has some political connection. So on an ongoing basis, you are supposed to do an enhanced due diligence. You are required to uh, monitor those transactions at a higher frequency, higher level of detailing. And as far as counterparty screening is concerned, if I am a CFO who have been entrusted by my client to sign checks on their behalf, and I'm, say for example, a CFO of a particular company, which is a subsidiary of a foreign company, and I get a call from the global CFO stating that you please transfer, say, $100,000 to this particular entity. Now, under my PMLA obligation, since I'm a chartered accountant, I'm supposed to understand who that counterparty is, to whom this payment is being made. So unless I have done those processes which are complete, I'm not allowed to transfer this money to those counterparties. Uh, Carrying out re-KYC and continued due diligence of our existing customers. Another important aspect which a lot of us tend to miss out is that all engagements which pertains to attestation function, they are governed by these KYC norms issued by the ICI on 1st of January 2017. All CA firms who get into this attestation function should invariably ensure that they have complied with the KYC norms. I'm not talking as of now about PMLA, but it is about normal attest function. And the same would also apply in case the CA firm happens to be a the KYC norms issued by ICI, you may read it. I will give you some few seconds. But this is what a CA firm is supposed to obtain from its client as a part of the KYC norms. So that was for individuals and corporate entities. This is for non-corporate entities like companies and LLPs. What is customer identification? What is its purpose? The purpose is to verify the identity of both the individual and non-individual clients engaging in financial transactions, and this extends to identifying the beneficial ownership. And who is the beneficial owner? So the regulation says that under section 2FA, it means an individual who ultimately owns or controls a client of a reporting entity, or the person on whose behalf a transaction is being conducted, and includes a person who exercises ultimate effective control over a jurisdiction person. So why is it important to understand what is beneficial owner? Because when you do a KYC of an investor, a customer of a CA firm, you are supposed to identify the beneficial owner. Now, what could happen here is that you have got a customer who is a subsidiary of a foreign company, a wholly owned subsidiary. So the law says that if it is a subsidiary of a wholly owned company, then you go and identify who are the individual directors and shareholders of that company who manage the company. If within the shareholder of that holding company, again, you find that there is a corporate entity, you will have to drill down to that level of identifying the real living person who manage or control this company. And that is where this is very crucial that we understand what is a beneficial ownership. And what are the criteria? The criteria are based on percentage of shareholding or profit sharing. This has been again defined by ICI. You may refer that document. What is customer due diligence? It consists of identification and verification of clients and risk assessment, applying enhanced due diligence and continuous monitoring of transactions. Risk profiling, why do we need to do it? It is based on the risk profiling of the client and the extent of due diligence. The frequency of transaction monitoring can be understood. So this gives you an estimate of at what interval you should be reviewing the client's transaction. So what kind of information can be used? It states that information such as nature of employment, business, geographical location, or any publicly available information can be used for risk profiling of the client. Some factor that should be considered while risk profiling, when you are doing risk profiling, is factors such as PAP, which is called politically exposed person, PEP, its involvement, the cross-border transactions should also be considered. So what is a PEP? So PEP is a person who has been entrusted with prominent public function by foreign country. So he has been given this prominent public function by a foreign country, including the heads of state, government, senior politician and senior government or judicial or military officer, senior executive of state-owned corporation, and important political party officials. So a PEP doesn't technically mean any person who is into politics. That's a general perception that somebody who is into politics is a PEP. No, that's not the case. It is specifically defined what is a PEP. Sanction screening. So while you are onboarding a customer or when any of the notified activities are being carried out, the reporting entity should identify that on whose behalf the activities are being carried out and to whom the payment is being made. If either of these entities appear to be on the United Nations sanction list, then the reporting entity will be under an obligation to not onboard a customer or onboard a customer but put it under enhanced due diligence. Risk assessment. So the risk assessment is to be carried out to understand the risk exposure, adopt a risk-based approach, implement appropriate policies, procedures, and controls, and document and update the risk assessment. Enhanced due diligence. So what is enhanced due diligence? It refers to more rigorous and robust measures undertaken by relevant person when dealing with complex, unusually large transactions or unusual pattern of transactions with no apparent economic or lawful rationale. When should EDD be conducted? It should be conducted when the risk of money laundering or terrorist financing are higher. What are some measures that are required in carrying out EDD? More frequent review of customer profile, application of additional measures like gathering information from publicly available domain, and reasonable measures to know the source of fund, which is commensurate with the assessed income, on which customer and the product profile, which may include conducting independent inquiries on the details collected on provided by the customer, and consulting a credible database, either public or otherwise. So there are a lot of database which are available. The moment you put either the name, mobile number, or email ID or similar such important information, it will throw up the name of the person to whom this belongs. It is just like what we do in our mobile when we got a phone call from unknown number. The way we use Truecaller, this is what you are supposed to do. You are supposed to, as a reporting entity, you are supposed to take help of third-party sources based on which you verify the information about the customer. What is a suspicious transaction? Suspicious transaction includes an attempted transaction, something which was attempted but not concluded would also form part of an attempted transaction. All attempted transactions are also to be reported to F5 India through ICAI. Whether or not made in cash, which to a person acting in good faith, it says gives rise to a reasonable ground of suspicion that it may involve proceeds of an offense specified in the schedule to the act, or it appears to be made in circumstances of unusual or unjustified complexity, appears to have no economic rationale or bona fide person, and gives rise to a reasonable ground of suspicion that it may involve activities relating to parent financing. Let me explain you this with an example. Say, for example, you are providing virtual CFO services to an entity, and while their predominant trades are into agri product, one-off transaction of a substantially higher value comes up for trading in gold. Now, as a reporting entity, we need to investigate. If it appears to have no economic rationale or bona fide purpose, probably we will have to conclude based on other investigation whether it is a suspicious transaction, and if yes, if it is a suspicious transaction, we may have to report it to the ICAI. So it says that special attention should be paid to all complex, unusually large transactions and all unusual patterns which have no economic rationale or visible lawful purpose. They should also verify the red flag indicators. The red flag indicators is a list of or a compilation of very important transactions which gives you an idea of what is required to be monitored under enhanced due diligence. So what are red flag indicators? Red flag indicators are signs that suggest a transaction or activity might be related to money laundering. So ICAI has given the list of tentative red flag indicators. This is not an exhaustive list. It is only for illustration purpose. But it says client receives unusual payments from an unlikely source, which is inconsistent with his sales. It matches with the example that I gave, where the client deals in agri commodity, but all of a sudden he receives an invoice for gold. So this is something which is a red flag indicator. So these are some of the illustrations which have been given, which one should carefully go through. While we may not be a reporting entity, still they are very useful in identifying certain transactions which otherwise will also be suspicious in nature. So where do we get these red flag indicators? If you go to the login to the SSP portal of ICAI, I have marked something which is PMLA compliance with black border. If you go to that tab on the dashboard, you will be able to download this entire list of red flag indicators. There are around some 50 red flag indicators provided by ICAI. Counterparty screening we have already covered. reporting to FIU India. So what we are supposed to do as chartered accountants? We have registered ourselves as a reporting entity if at all it is required. We are supposed to do the KYC of the customer. We are supposed to monitor the customer's transactions on an ongoing basis. Having done that, one day, based on the red flag indicators or otherwise, we identify that a particular transaction of a customer seems to be suspicious. Then we are supposed to report it to ICI. They have developed a portal on which you can report this. And once that has been reported, the ICI in turn will verify all the the credentials and everything. And having done that, it will forward it to FIU. So if you are registered as a reporting entity, what is that you are supposed to do? On a periodic basis, you are supposed to file the cash transaction report, which is the 15th of the succeeding month. It is to be done not for every cash transaction, but it should be only if an individual transaction exceeds 10 lakhs, or there are series of connected transactions exceeding 10 lakhs within a month, or its equivalent in foreign currency. So if this is the case, then only by 15th of the succeeding month, a cash transaction report is to be filed. Similarly, suspicious transaction report, you may refer to the red flag indicators provided by ICI. But the moment the RE, which is a reporting entity, forms an opinion of a transaction being suspicious in nature, it should report to report the said transactions to ICI within 7 days. Wire transfer, the threshold is 5 lakhs to be reported by 15th of succeeding month. And for NTR, again the threshold is 10 lakhs, to be reported by 15th of succeeding month. So what is the penalty for default? If as a reporting entity, I miss out reporting some transactions. So it says that penalty on defaulting REs or its designated director or any of its employees shall not be less than 10,000 rupees, but may extend to 1 lakh rupees for each failure. So this is something very critical. So for example, client kept on transacting, and there were 30 such transactions. But since as a RE, I did not have the bandwidth or procedures in place, I missed out reporting those 30 transactions of my client. So I have one client whose suspicious transaction report has not been filed, but in turn there were 30 transactions, the underlying transactions. So the penalty would not be 1 lakh, but since it is for each failure, the penalty would be 30 lakhs rupees because there were 30 failures on my account. Can civil or criminal proceedings be initiated against the reporting entities, designated directors or principal officers for reporting to FIU India? So it says that no prosecution is contemplated under Chapter 4 of the PMLA for default in compliances. Section 14 of the PMLA contemplates that no civil or criminal liability proceedings shall lie against the reporting entities entities or its directors or employees for furnishing the information. So the law is not supposed to be a civil or criminal liability, but yes, it could entail penalty for any lapses. Tipping off, it says that you are not supposed to tip off the customer. So if there is a customer for which you are acting as a CFO, virtual CFO, managing their funds, and therefore you are a reporting entity, and you identify that they have been recurringly making some cash transactions, or they have been involved into transactions which lack economic rationale. So the law says that you are not supposed to go and tell your client that you stop doing this, else I will have to report this transaction to FIU India. You should allow the client to work as he is without disturbing him, without tipping him off. Your job as a good citizen, as a reporting entity, is not to stop the customer. The task that is given to us as a reporting entity is we should file an STR with ICI. Maintenance of records by reporting entity. It says that under Rule 3, all the transactions which are required to be reported should be preserved for a period of 5 years. What records should be available? So it says nature of transaction, amount and currency of transaction, the date of transaction, and parties to the transaction. And this is required to be maintained for all the transactions once you are a reporting entity, and not only the transactions which are of specified nature. One important aspect is hiring, where you will have to do enhanced screening. There are a lot of people who don't do screening because the chartered accountant firms have employees who come with references and they are hired without obtaining any identity or address documents. So it says that you will have to do that enhanced level of documentation. You will have to train your employees on various aspects, which includes KYC, CDD's customer due diligence, sanction screening, record keeping, transaction monitoring, and your instruction manual for the above should also include all this training material. At what periodicity these policies and procedures are to be reviewed? The law is silent. It has been left to the discretion of the reporting entity, which is the CA firm. We will not go into the role of ICAI, but it is like a SRO, which is a self-regulatory body of chartered accountants, and therefore it will act like a regulator. 9th May notification also includes formation agents of companies and limited liability partnerships, or those acting as directors, secretaries, or companies and partners of firm, those providing registered office, business addresses, or accommodation, correspondence address, or administrative address of a company or a limited liability trust, limited liability partnership firm or trust, or they are acting as or arranging for another person to act as a trustee of an express trust or a nominee shareholder for other person. So if these are the other activities that a chartered accountant is doing, he may not be governed by the 3rd May notification, but he will be governed by 9th May notification. This is irrespective of whether you are a chartered accountant or not. I have given the list of references which you can refer to in case you need to study this subject in detail. But my request is that everybody should go through the FAQs which have been issued by ICAI on the Gazette notification of 3rd May and the red flag indicator. This is the bare minimum. I have given links to the forms of ICAI for registering yourself as a reporting entity if that is required. Another link is to the KYC norms which have been issued by the ICAI. And the third link is to the sanction list which has been provided by the ICAI. So friends, thank you for a patient hearing, and I would be happy to address your queries. Gyati, over to you.
Thank you, Kendu sir, for such an insightful session. There were a few questions which I posted in the chat box. Should I read them out, sir?
Yeah, please.
Someone is asking whether loan taken in India and remittance outside India for real estate purpose fall under PMLA.
So the question is, loan has been taken by whom? So because, I mean, if we look at this notification, it only applies to reporting entities. So first, you should be a chartered accountant in practice. You should be actively managing the client fund. So if you are working like, say, for example, a virtual CFO of that company, where you have the authority to manage their bank account, you become a reporting entity. And then if that entity has taken a loan and has remitted outside India, and if upon scrutiny it appears to be suspicious, then yes, the reporting entity would be required to report it to ICAI. But if you see, what happens is most of the time you are just an auditor or a consultant. You do not act or manage their funds or other assets. Then you are not a reporting entity. So you then are not a reporting entity, and therefore you are not required.
Okay, sir. Then we have the next question. They are asking, is black money, is there any act for black money? Is Black Money Act different from PMLA?
Yes, Black Money Act is a separate act. I mean, it's a provision of law, separate provision of law.
Okay. Then we have the next question from a member. He is asking, can a CA be arrested like politicians under PMLA?
Yes, and we have a lot of such instances where it was the law enforcement agencies, they suspected that there was a chartered accountant who has abetted the crime of money laundering. So they were also charged with the offense of money laundering, and they were also put behind bars.
Okay, sir. Then we have the next question. He's asking social media frauds where stolen money is transferred by fraudster using mule bank accounts, MULE bank accounts, which have limited transactions. So, how far is the system working and information used by ED to prevent or enforce PMLA?
No, I think that is something is see. First of all, we need to understand we are not here to evaluate whether enforcement department is working efficiently or not. The entire objective of this session is to understand what is our responsibility as chartered ED and everybody is. I mean, I know a lot of people, including the Home Ministry. They have a lot of concern for what digital frauds are happening, and they are putting their best efforts to ensure that they do not occur. But at the same time, it also needs a lot of caution by citizens of the country. That awareness is required.
Okay, sir. So member has also added one more thing into this question that that I understand substantial fund movements in such accounts are to be reported by banks to FIU by the way of exception reports. So, will it make any difference to your answer?
See, again, bank is a reporting entity. Bank is supposed to do that. If it finds those transactions to be suspicious, they are supposed to report it to FIU India. And once that is reported, yes, definitely FIU India will work on that.
Okay, okay. I hope that answers this query.
Yeah, but that doesn't pertain to a chartered accountant as a reporting entity.
Okay. Then we have the next question. A member is asking, recently there were many cases of online loan scams by private limited companies involving foreign citizens where illegal activities were carried out violating FEMA and PMLA. As part of government action, ED or other government agency issued notices notices to a number of CA firms which had enabled registration of these companies or acted as auditors. What is your opinion on the liability or responsibilities of CAs in such cases?
As a responsible professional and gatekeepers of the entire financial system, I think we should be exercising highest level of due diligence when we act for or on behalf of our customers. We should not only be doing a superficial work of just obtaining the documents and filing it, but yes, that is required, definitely required. The question here is, what is the role of the chartered accountant into this? In my view, all those who were arrested, they had not only certified those entities or their EMPs to be in existence, which at point of time were not in existence, or they were not physically verified or inspected. A lapse on the part of some of those professionals. This facilitated huge amount of money laundering. So obviously that was a threat to national security and the government had to act upon it. In my view, those chartered accountants should have exercised due diligence of asking those directors to be present before them, verifying who are going to be the shareholders of that company, whether it is an Indian company, whether they have verified that these people exist on earth, and what is the sanctity of those people becoming directors or shareholders. And based on that, had they certified those documents, that would have helped them to prove that they had exercised all the necessary due diligence.
Thank you, sir. Moving to the next question. Vikal Nirulkar is asking if during customer onboarding, the client is rejected due to some red flag, do you have to report such rejected customer also?
Yes, because it says that any attempted transaction. So if you reject it, this becomes an attempted transaction. And if that transaction is an attempted transaction, and you find and you conclude that yes, it appears to be suspicious, then you need to.
Okay, sir. Then we have the next question from Vancheshwar. He's asking for incorporating a company. The client hands over funds towards various payments for preparing MOA, AOA, making NPA fees, etc. to CA. Does this amount to dealing of money under PMLA?
No, that I have clarified. I mean, FAQ also states that pure money which is coming in as fees for making it payment, I mean, the government fees and all those things, they are not included as and payment handled by chartered accountants.
Okay, sir. The next question is ultimate beneficial owner details required for a client where we are not providing the services covered under PMLA. Example, in case of an audit of a foreign subsidiary or a PE fund, it may not be readily available.
See, let me tell you first, audit function itself is outside the purview of this notification. So if you are an auditor, this doesn't apply to you. You may be governed by your code of ethics and standards on audit. That's a different thing. But let me tell you that if you are acting as a virtual CFO, where there is a PE fund which has come to India and you have been made a CFO, you are allowed or you have been entrusted to make payments on their behalf, you will have to do a ultimate beneficial ownership test. If that company is unable to provide you requisite document, that becomes a suspicious transaction and you will have to report.
Okay, sir. Then we have the next question. Well, providing 15CA, 15CB services, is covered under the services which we have mentioned.
No, it is an attestation function, not covered.
Okay. Moving to the next, can we report a suspiciously looking transaction which pertains to a period earlier to the period for which we have been appointed as a professional involving fund management function?
Earlier to what? Earlier period means earlier to what?
Earlier to the period for which we have been appointed as a professional.
See, what happens is, I mean, you are supposed to look at it holistically. So it is a series of transactions. When you are investigating it and you identify that these are series of transactions when put together, would have a higher level of suspicion. And you conclude that, yes, if I put all these 15, 20 transactions together, even prior to my appointment, I conclude that, yes, they are suspicious, then yes, you will have to report it as suspicious transaction.
Okay, sir. Then we've got a lot of questions today. Member is asking, project financing is covered, but what if CA is only representing for CMA preparation?
I would advise that if it is only CMA preparation, take an engagement letter that it is only CMA preparation and you are not going to manage or organize money. So you are not going to liaison with the bankers or institutions.
Okay. I hope that answers this question. Then C.S. Durga Prasad Akela ji is asking if two RE are involved in, is any RE reporting enough or both has to report separately?
Both in the sense?
Means if there are two REs, so reporting by one RE will be sufficient or both the REs will have to report?
So let us take an example that there are two chartered accountants who have been appointed as virtual CFOs. And both of them have been allowed to sign certain payments and handle payments on behalf of the client. Yes, both of them will have to report. They have independent responsibility.
Okay, so sir, then we have the next question. Sir, a client who is in the real estate agent business got a notice from PMLA authority to get themselves registered as reporting entity. What could be the reason there was no explanation given in the notice?
Again, outside the scope of this today's subject, but let me just clarify this. Every reporting entity are required to go and register on the FinNet Gateway portal. The exception is the profession of chartered accountant, company secretary, and cost accountant who are required to register with their regulatory bodies. So all these real estate agents, they had not registered themselves on the FinNet Gateway. The question is, if you have not registered, how do the agencies monitor you? And tomorrow, if there is a suspicious transaction or a transaction which needs to be reported, if you are not registered, you will not be able to report those transactions. So that is why this notice has come to everybody, where they have been asked to register. This is nothing beyond that. So there are no reasons required to be given because the law states that you are to be registered.
Okay, sir. So I think, sir, all the queries have been answered. In case members have more queries, they can definitely post it. So there are no further queries right now. We have one addition to the previous query, which was regarding CMA preparation. Member has added that, but even CMA sometimes, but even for CMA, sometimes bankers are asking for CA to sign the CMA report. So then, will they be covered under those services? Will it be covered under the scope of project financing?
Signing, first of all, I understand that chartered accountants are not supposed to sign projections. So that itself is a violation if you are doing that. But leaving that apart, if your role is not to liaison and arrange for the funds, but it is only to the extent of CMA, whether you sign it or not, will not make you a reporting entity under the PMLA of third May notification.
Okay, sir. So I hope that answers the member's query. So we're done with question and answers. So we extend our heartfelt thanks to Mr. Kinjal Shah sir for his insightful and detailed deliberation on Prevention of Money Laundering Act, and your session provided a clear understanding of critical aspects like Section 3, Section 5, and the reporting obligations, making complex regulatory requirements more accessible. And this session has empowered us to better legal and operational phases of PMLA, and we look forward to implementing the takeaways and practices to ensure stricter adherence to AML regulations. So thank you so much, sir, for your valuable time, and thank you all the listeners and participants for their time.
Thank you. Thank you very much.
Thank you, sir.